I don't know. It's going to be because the first midterm covered chapter 1 and 2. So we are going to complete chapter 1, chapter 2, the note today, and maybe by this Wednesday we are going to finish it. So next week, Monday, no class, but on Wednesday next week, I'll go over the study guide or the practice set for the test for the first midterm on coming Wednesday. Any other questions? Anyone has any question before we continue? Any questions? Give me 1 second. Okay, this is the notes. Okay, so we went over the chapter 2. We're looking at the word accounting for the business combination. So we talk about the parent company. We also discussed the changes that have been taken effect since 2007. There's a lot of changes that have taken effect. We went over some of the changes, which is right here. We also went through the acquisition, accounting, acquisition of the assets. We talk about that. Such a business combination. We talk about that. And then we also, so this, I think we didn't do, yeah. So looking at example 1 that we have here, the first example is that this is the balance sheet of both the parent company and also the subsidiary company before the acquisition, before the two companies decided to join together, or before the P company decided to buy the S company. Now, both of them have the cash. If you look at cash and cash receipt, the book value of the P is what 250,000. The book value here is 180. The fair value is 170 for the S company. Our concentration is on the S company because the S company is the company we are buying. The company we are buying here. They have the inventory, which is now valued at 140. They have the land, which is now valued at 400,000. They have the building and equipment, 900. Now in the market value is what 1 million. So the total asset less accumulated depreciation of the 300. So 1 million is the book value. Now this one is supposed to be here. Let me bring this one here. Okay, so the total asset now is 1,710,000 based on the what? The fair value. Then we have the current liabilities. The fair value is 150. They have the word bonds payable, which is 9% due on the 2021, which has the word the interest payable of the word 350. Now, the reason why you see the 400 here and the 350 is because of the what? the decrease in the what in the bonds. So we have half 500,000 and the book value is what 510. Now the stockholders equity section, we know we have the common stock of the what the parent company, we have the common stock of the subsidiary company, we have the other contributed capital of the subsidiary company, retained earnings of the subsidiary company. One of the things I want you guys to take note of is these 3 items here. It's very important. The common stock of the subsidiary company, the other contributed capital of the subsidiary company, retained earnings of the subsidiary company. On chapter 3, we are going to eliminate these transactions. We are going to eliminate the transaction because against the investment that the P company is investing in the world, in the subsidiary company. So we have it at the part 1.2. Now it's a one net asset at the fair value. This a net asset simply means that you take your work. Remember the goodwill that we calculated? You take the 500,000, you subtract from the total asset here, it give you the net asset of this one. P company now have to make an adjustment, right? P company have to make an adjustment for exchange of the stock of the net assets. So we are going to debit all the asset of the what? The subsidiary company and kind of liability. So if you look at the asset, they have the cash and cash equivalent. We didn't use the 180 because the market value of the cash and the receivable is now 170. So we need a 170, not the what? The 180. All assets, remember the new rule, all asset liability should be valued at the fair value or market value on the day of the acquisition. We have the word inventory, which is no longer 120, is no longer 100, is now what 140. We also have the word the land, which is no longer 120, is now 400,000. We have the PPE, no longer 900, is now what 1 million. Then we are going to credit the debit a discount on the bonds. That was the difference between these two here I was talking about. That's the 50,000. Then we credit the what? The asset, the liabilities. 150 for the current and the what? The 350, 400 here of the what? The bonds payable here. There's two ways. You can remove this one and record this 350 by the same. Now, here we are giving them the common stock. This is what they said here, and I want you to look at this one here. Assuming that on January 20, P company in a merger acquired the asset, assume the liability of the S company. P company gave up one of each $15 per value. This is the key here. $15 per value, common share to the former stockholders of the S company for every 2 shares. This is for every 2 shares of the $5 per value. Common stock they held throughout. So P company and S are frequently used distinguished at the subsidiary company and the S company. So if you look at here, they are exchanging the shares of the 30,000 shares here. Our 30,000 shares here multiplied by the 15, which is the 15 of the share here. The par value is the 15. That give us the amount of the 450. But in our market, we're told that the share value of the market is a $48 here. $48 here. So it's going to be other contributor capital is going to be the 48 minus the par value of our share of the 15. That give us the 990. Is the extra money that we are receiving because of the par value. Now, the reason why you see these 30 shares here is because of this. They say we exchange half. We exchange for the half. That's what it's saying here. Where is it? That in this asset is said I want to common share of other for every for S company for every 2 shares that they have. So we divided this 60 shares that the S company have here divided by 2. That give us the 30 shares. Therefore, this is the goodwill. The goodwill is the difference between your credit side here and your debit side. Or remember the net identifiable assets minus the consideration. That give you the goodwill amount here. So when you add everything here, that give you the 1,210,000. When you add everything here, credit side give you the 1,440,000. So the difference between them here is the goodwill. Is the goodwill amount. Now, what if now P company balance sheet, we have to combine the two companies together. So the balance sheet of the P after the acquisition is going to be as follows. And one, the cash here, P company cash is 250. S company cash is the 170. So you're going to add them together. Inventory 260 here plus the 140. Land 600 here plus the 400. Burden 800 here plus the 1 million. less the accumulated depreciation as well. So that give us the total asset here. Then we also have the cash assets, accumulated depreciation, that give us the total asset here. We have the current liabilities, which we added two together, bonds payable, less the bonds discount, 350 total liability here. This is where remember I told you guys here. Once we are buying the company, we are buying the asset of the company. Therefore, we are not going to what? This common stock is gone. This other contributor capital is gone. This one is gone because we have acquired the equity of the company. We acquired the equity of the company. So all the equity of the S company, which consists of the common stocks, other contributor capital, retained earnings will not be carried forward because we have closed the equity. We are buying the investment, therefore their equity will be closed. So if you look at here, the balance sheet here, we have only the common stock of the parent company, which now equal to the 80,000 shares. Why 80,000 shares? We bought 30,000 here and we have the 50,000 here. So together we now have 80,000 shares. That gives us amount of 1.2. We also have the other contributor capital, which is the 400,000 plus our other contributor capital that we have here. That gives us an amount of 1.380. The retained earnings, our retained earnings are 350. The retained earnings of the S company is gone because we bought the company, therefore their retained earnings and their other contributor and the common stock will not be recorded. We have eliminated them, so we are not going to record that amount. Any question before I continue? Before I continue doing some exercise, any questions? Any? Are you guys here?
No questions.
Yes, Professor.
Okay, so let's start do so. I'll come back to the treatment of the other expenses, which is not really to this, and I'll come back to do that. But let's do some of the class exercise so that we can get more understanding of this. Give me okay. Yeah, it's this one. So if you look at the first one here, now you are given the asset acquisition. This is an asset purchase. So Hope Company acquired the asset. You see, except they are not buying their cash. This is very important. They are acquiring everything except that they are not acquiring the cash. They are not acquiring the company. So this you cannot take this. Now they are and assume the liability of the Faith Company immediately prior to the acquisition. Faith Company balance sheet before the acquisition. This was the Faith Company, not the Hope, Faith. So assuming that, prepare the journal entry of the company and assuming that the consideration or the amount paid by the Hope to get the company is a what? 780. That is A. B, repeat the same requirement here, except that they are now paying what? 495. 495. So let's do together here. So we have the part one of the part one or part A of the question. We are buying this company. All the assets of the company should be eliminate, should be debit. We cannot debit cash because they said everything they purchase except cash. So we are going to debit the account receivable here, which is the net account receivable net here. The market value is a what? If you look at the market value, it's 114. So we are going to debit this 114. By the way, this is your debit. You guys know this is your debit. This is your what? Your credit here. We are also debiting the inventory, which is the market value is a what? 1,191,998,000. We also have the word PPE. Let me see if I can have the PPE here, which is market value of 270,000. Here we have the what? The land. The value of the land is the 330. Now we have the what? The current liabilities, which is the current liability is only one. So let's put the what? The liabilities. The liability is a what? 297,000. 297,000 here. And then they are giving them the what? The cash consideration they are giving is cash. Which is amounting to, they are paying 780,000 here. So how much is the goodwill now, if it's any, right? So you remember the consideration is equals to, or the goodwill, I'm going to put the quote here. Oh, let me put it here. You guys know that the goodwill is equal to the what? The consideration, if you guys remember, less the what? The net.
Identifiable asset.
Very good. Identifiable asset. So let's do it together here and let's see how much the consideration, or if any, how much the goodwill here. Now we know that based on that, the consideration here, we know that the consideration that they are giving here, sorry. Oh, that's not one of the people. I'm coming, I'll attach it again. Give me a second.
Yes, sir. From where did we get the 780,000 for cash?
Right here. You see, they said they pay
Okay.
cash of 780.
Thank
They
you.
pay cash of 780 here. Okay. So let's look at this. So therefore, the goodwill is equals to, the consideration is a what? 780, right? Minus the net identifiable asset, which is you are adding all these three here and subtract the what? The liabilities. So I don't know, you guys want me to do it here? Let me see. Maybe I don't think. So can somebody add it for us? If you want to add 114,000 plus 198
It's
plus,
912,000.
come again?
912,000 minus
900.
227.
Oh, okay, yeah. So how much do you have?
615,000.
615,000. So how much is the goodwill then? How much is the goodwill? How much extra money?
165,000.
165.
165. Do you all agree before I continue? So the goodwill is a what? 165,000. So this is the goodwill here. 165,000. So the goodwill, you can also do it here if you want. I can do it here, 780,000 minus the what? The identifiable 114 plus 198 plus 270 plus 330 plus, no, minus the what? Minus 297. I think it's going to give you the same thing. So this is the what? The goodwill. Any question before I continue? So the excess money that we are paying to get this company, because we have done our research, done the homework, and know that it's a good company, is going to give us a good. This one is award the 165,000 for the part A. Any questions?
I have one question.
Yes, of
Why
course.
we didn't included the cash 60,000?
Because of here.
Ah, thank you.
You're welcome. They bought everything except that cash is not included. They are not acquiring the cash of the company. So that's a good question.
Thank
Now
you.
let's go. You're welcome. Let's go to the B. Part B said what? It said repeat the same thing, right? Repeat the same thing, except that now the cash they are paying. Oh, something is missing. Where is it? Was somewhere here. Where is it now? Oh, right here. They are now paying what? 495. So in other words, we are repeating the same thing here. I don't know about the goodwill, so I'll leave the goodwill out, right? We don't know whether it's going to be a goodwill or not. 1, 2, 3, 4. Or it's going to be a bargain. So let's leave it now. We have here, right? Then we have the liabilities. This one, we are going to change the cash. Yeah, so let me see. It's not going to help. I don't know what is going. So let's leave one line. I don't know what is a goodwill or so liabilities. And then consideration, we are giving cash. We are giving cash liabilities 297, no change. But this one is now 400 and 490. 495,000 is how much we are giving now. So those who calculated, so is it a gain? That's the question. Is it going to be a gain or is it going to be the what? The goodwill, right? So let's see. You can do the same thing here. I'm going to code the same thing that we have here. Remember, when you pay, when your identifiable asset is greater than the what? The consideration, it means that you are gaining. You are paying less money. So it's a gain on the sale of the acquisition. It's a gain on the sale of acquisition, like we did on the what? On the notes. So we know that we don't know whether it's a goodwill or not. So let's see here. That's with a negative goodwill. So consideration, we know is a 495, right? We know it already. You guys did this one. You said 900 and 615, if I'm not mistaken. Yeah. So what is happening here? This is a what? Negative goodwill. That's what we call the what. So it's a gain on the what? On the acquisition, because it's a what? Negative goodwill. So we are gaining. It's a gain on the what? The acquisition, because it's a what? It's a negative goodwill. Or in other words, it's a negative goodwill here. So how much is the gain here? So this is going to be what? Gain on business combination. So how much the gain?
120,000. Yeah.
130, right?
20.
No, 20.
120. 120. So this is a gain. Should I come back again now? It's okay. I can come back if you want. Or it's understandable. Once you pay less than, or once the net identifiable asset is greater than the amount, the consideration that you are giving, it means that you gain. The value of the company is 216, right? The 216 here. And you are paying only 495 to get a company. So you are gaining. But here, the consideration is you are giving up 780, but the actual value of the company is what? 615. So you are paying extra money in order to get the company. Any questions before I continue? The floor is open. Any question? Or is that
No.
okay for me to continue?
Yes.
Okay. So let's look at the 2-2. 2-2, the balance sheet of the Hello Company and Good Day Company before are presented below. On the date on that day, after the extended period of negotiation, the two companies agreed to merge the company together. To effect the merger, Hello Company is to exchange. So Hello is giving up its on issue common stock of all the outstanding shares of the Good Day Company in the ratio of what? Half. So in other words, if the Hello Company share is about maybe 20,000, they are buying half of it in exchange. They are exchanged for the water, half of that shares of the Hello for each of the Good Day Company. Market value of the shares were agreed to be 24 for the Hello and the $12 for what? The Good Day. Our main concern is this one. We don't care about this one because we are buying the company. So we care about how much are we getting extra money from the buying because of the market value as compared to the par value. The fair value of the Good Day Company asset liability are equal to their book value, except that plant and equipment is valued at the 360. So in other words, when it comes to cash, is the same amount, receivable the same amount as the market value, inventory the same amount as the market value, except that when it comes to the PPE, it's not 400, it's a 360 according to the market value, according to the market value here. Liability is a 160. Common stock, you see 8%, 400 here, right? So other contributor capital, there's no other contributor capital here. Retained earnings 880 and 180 here. So prepare the balance sheet for the Hello Company immediately after the company is merged together. The first thing you have to do is that it's easy to do the balance sheet, but it's always better to do the journal entry to know whether there's a goodwill you are paying or etc. Always you have to do that. So let's do the journal entry here before. So let's do the journal entries. Then we can see if we are paying extra money here. So we know we have to debit the cash. So we are going to debit the cash here. They didn't talk about assumption of the cash. They say we are buying the company. We are merged the company together. So we are assuming that the cash, they are acquiring the cash here. So the cash here is 100,000. So we have cash of 100,000. Remember, this is your debit. And this is your your credit. So the cash is 100,000. Okay, they also have the receivables. So they have the receivable. Give me one. The receivable is 120,000. They also have the inventories, which is a 400,000. Is it? Oh no, also 120. Then they have the PPE. The net of the PPE here is 360,000. Why 360,000 is because of here. They said when it comes to the PPE, except the plant and equipment, the market value is what? 360,000 here, 360,000. Then we have the what? The liabilities. So the liability is a what? 160,000. 160,000. $160,000 is the what? The liabilities. And then they are giving the what? The common stock. Now, what we have to do is that, you see here, they didn't give us the number of the shares. Even though they give us the what? The par value of the shares, but they didn't give us the what? The number of the shares here. So we have to calculate the what? The number of the shares. And you guys did this one integrated accounting. If share is issued at $8 per and the total amount that we receive is a 400,000, then how many shares do we issue? How many shares did we issue? Yeah, Jason.
You have to divide the amount of money that you receive by the par value.
Very good. So we are going to take this one here. That's correct. You're right. So we are going to take the what? 400,000, right? Divided by 25. How much do we have? Oh, sorry, 8. Divided by 8.
50,000.
It's $50.
50,000.
50,000.
50,000. Yes, very good. So this gives us equal to 50,000 shares, right? But what is the rule? It said we are multiplied by what? 1/2. Why 1/2? Is because of what they said. I'm coming back. I'll show you right now. So this here, then we are going to multiply times $8. I'm going to show you right now. Don't worry here. It's because of this one here. It said half. You see this one here? You see, it said the effect Hello Company is exchanging it on issue common stock for all the outstanding shares of Good Day Company in the ratio of the what they have. So that's why we took the 50,000 shares, then divided by the what? The half. Oh, I multiply, sorry. Divided by the half. Give me 1 second. Divided by the half. That gives us, I don't know, is it 25,000 shares? Then
Yeah,
multiply by the 8.
25,000, which is
Okay, so how much do we have?
200,000.
200,000, right? 200. But what happened? Our shares are being sold at the what? $24. So we are getting extra money. So we are going to credit the what? The other contributed capital of the extra money that we are receiving. For the extra money that we are receiving because our company is doing well. So the market value is what? Is up. So here, now it's going to be, can I take the only 25,000 shares? Is that okay for you guys? Or I should do the same thing, like 50,000 shares divided by the what? 1/2. Yeah, multiply by 24 minus 8. Multiply by 24 minus 8. Why 24? Is because our share is now being sold in the market of the what? 24. So we are gaining extra money. So how much do we have here? Oh, somebody put it there.
It's
Oh, no.
400,000.
400,000 here. Any question before I continue here? Any question before we continue? Any question, please?
Professor, why would we
Yes.
have to divide by the number that was given to us?
Because of this one here. So we are exchanging half our stock for the half of their shares. So if their share is 50,000, which is the what? The 400,000 here divided by 8 give us the what? It means the S Good Day share is 50,000. They have the what? 50,000. I'm going to take it off. Don't worry. 50,000 shares. but we are exchanging 1/2 of our share for their 2. So divided by the what? Or multiply divided by 2, right? Or multiply by the same 1/2. That give us the 25,000 shares.
Oh, below
good.
it says divided by 1.
Yeah, because in the ratio of 1/2. Oh, you're talking about this the calculation here, right? Hold on.
So is it multiplied?
Let this one here. That's why you see I divided by the same as multiplication, but that's why
Okay, so it should be multiplied.
yeah, so like something like this, right? I think so. No. Yes. Or you can directly divide it by 2. You can easily divide it by 2, right? You can easily divide it by 2, which is the same amount, 25,000 shares. Have you done? Now we want to determine, is it a goodwill, positive goodwill, or negative goodwill, right? And you guys know. So our goodwill is always equals. I want you to keep this formula in your head. But as we move on, this one is going to help you a lot, knowing the goodwill calculation of minus the what? The net identifiable what? Asset.
So we are
Right.
paying them stocks, right? To bind the company.
Yes, very good. Remember the consideration 3. You can either give them cash or the debt, or you can give them the what? The stocks. Remember the chapter 1.
And I'm just confused. Like we are getting their stocks and then we are paying our stocks.
Okay, so this is what is happening. Let's go back here. This is our common stock, right? Our shares is okay. We can divide it. We're going to know how many shares. And this is their share. So we are buying this company. What we are exchanging is that we are getting their what? We are giving them the common stock instead of giving them what? Cash. But the common stock that we are giving to them, for each of their common stock, right? We are exchanging it for half. So our 1 shares will be exchanged for the what? 2 of their shares, half of their shares. Does that make sense now? Before I continue.
Yes.
Okay, so let's go back. So first, this is what has happened. You have the company. So let's assume that it's your company. Your company is what? A. My company is a what? Is B company. Now we are trying to make these 2 companies together. But in order to do that, Hello company, which is my company, is exchange it on issued common stock. So we have some common stock we have not issued yet. It's outstanding for all the outstanding share of your shares. So if you have 200 shares, I'm exchanging my shares with your shares. In order to do that, each of 1 share, so Good Day Company in the ratio of 1:2 of Hello for each share of the Good Day. So if I have your 200 share that you have here, I'm going to exchange 1 of my share to get 2 of your shares.
Okay, it's
So-
just a price difference.
Yes.
Yeah.
It's good now?
Yes, Professor.
Okay. So that is so here we want to know now we know the consideration we are giving. Now, what are you giving? We are giving the what? The number of the shares here. So there's 2 ways. You can either add all the debit side the same and add the credit side here. The difference will be the goodwill. So I want one person to add all the debit side and let's see how much the debit side is equal. How much the debit side is equal, the total debit side, and one
Last
person should add the
question.
what? Yes, of course.
How we got a 8?
Which 8? Oh, 8 is right
Yes.
here.
Okay.
See the par
Yeah.
value? Remember
Mhm.
the intermediate accounting. When you got the intermediate accounting, a company can issue their shares above the par, below the par, right? If the company issue their shares above the par, they have the what? The PIS, excess of the what? Paid in capital. if you got to remember, excess or paid in capital. So here is the excess money that we are receiving because our stock price is what? Is up. Our stock price, which was the par value of 8, is now being sold in the market of the what? The $24. That's why we get the excess money here. It's good?
Yes, Professor.
Okay. So can somebody add it for me? And let's see the debit side. We can add the debit side and then the credit side and see.
700,000.
The debit side is 700,000.
700,000 and the credit side
760.
7.
Yeah,
760.
760,000.
So there's a goodwill, right? The credit is more than the debit. So goodwill is always a difference. Remember, it's a difference between your what? Your debit and credit. So you guys said 770. Is that this one? Minus 700.
No, it's 700,000 for the debit side, and the credit
Uh-huh.
side is 760,000.
Oh, 60,000. 6.
Yes, for the
Okay,
credit
like
side.
this, right?
Yeah, yes.
So the difference of the goodwill is the what? 60,000 is the what? The goodwill. The 60,000 is the what? The goodwill. The 60,000 is the goodwill. Now, remember, you can do that or you can go by the what? Our definition here. Our consideration here is the what? 600,000. Because of what? 200 plus the what? The 400, 600,000. Now,
660,000.
6
660,000.
here. Remember, we are not going to include the liabilities.
Okay.
If we are using this formula, then you don't include the liability, you include only the word consideration you are giving, less the word now come in, right? All the total asset here, which is going to be, I think, 500 and something. If I'm the total asset here, right? This, how am I the total asset? Don't include the goodwill.
700.
700. 700, very good. 700,000 minus the liability of the what? The 160. So this means that this one here is equals to 600,000 minus the what? How much is this 540? 540, right? So the goodwill here is equal to the what? 60,000. So either you add all the debit, you add a credit to find your goodwill or the gain, or you use the formula to find out what the goodwill or gain. Is it good now before you continue? It's good?
Yes, Professor.
Yes.
Okay. Okay, now we can prepare the balance sheet because this is what we need in order to, if there's any goodwill. So we know, oh, okay, there's a goodwill. So now we have the what? The balance sheet. We have the what? The cash. We have the what? The receivables. Let me see if I can copy. I can copy one, but I can. We have this one. I will change the receivable. Don't worry. We have the PPE. We have the total assets. We have the what? The current. We have the common stock. Other contributed capital. Retained earnings. Then we have the total equity. Give me 1 second. I need first. Okay, then we have the total. Are we missing anything? Liability, common stock. Okay, then we have the total equity. Okay, now let's look at the cash. The cash is going to be the combination of the what? This guy is bringing cash. So good. Hello, company cash at 240,000 plus the what? The cash of 100,000 that they are combining together. When it comes to account receivable, I want someone to start doing the calculation. They are 240 plus 120. When it comes to the inventory, they have good day. Hello is a what? 1 million in inventory plus 120 of the hello. When it comes to the PPE, they have 1,920,000 plus 360,000 here. When it comes to liabilities, they have 600,000 in the liabilities plus 160,000 in the liabilities. When it comes to the common stock here, the common stock, we have already done the common stock here, which is equals to I'm going to do the common stock here to be easy. They have the common stock 1 million. 1,720,000. They didn't buy all of them. So plus into bracket, remember they bought a half of their, you can just do direct here, or we have already done that one already, which is right here, the 200,000 plus the 200,000 here. To cut the story short, plus the 200,000 here. So on this one, we have the other contributed capital 200,000 plus the extra money that we get here because our market value was high. The retained earnings is only one. We don't care about the retained earnings of the parent company. We care only about the parent, not subsidiary, which is in this case here is 880,000. Now let's have the numbers. If you guys are finished, how much is this one here? I can do this. I don't need a calculator. I think 340. What about here?
360.
360. Somebody should start adding the numbers for us up. And here, is it 120? Am I right?
Yes.
Okay, and this, I need help.
2.280.
280, thank you. So how much the total asset here? How much the total asset? How much I can maybe, but somebody should verify that number for me. Is it 4.1 million? Oh, we are missing something. Who can tell me? We are missing something. That's the goodwill. We didn't include the goodwill, so let me set the goodwill somewhere here. Insert. Goodwill was 60,000, right? Yeah, it was 60,000. So this is what the goodwill. Now let's see. This one equals to, is it 760?
760. Yeah.
What about here? Hmm,
That's 1.920.
1.920. Thank you. And this 600, right?
Yeah.
600,000. So this one, somebody should verify the number for us. Oh, a balance. So this is the total, and this is the total asset here. I'm opening the floor for any questions. Any questions before we continue? Any questions?
Yes, Professor. Why retained
Yes.
earnings were only from Hello Company?
Good. Remember what I said when we started here. When you are buying the company, you are buying, especially we are buying the stocks of the company, equity. So any equity of the subsidiary company, we are not going to record them. And as a matter of fact, chapter 3, we are going to eliminate the common stock of the subsidiary company, the other contributor capital of the subsidiary company, the retained earnings of the subsidiary company against our investment that we are making. So once you are buying the company, you are not buying their retained earnings. The retained earnings is their own money that they have earned. Does that make sense? So they are not going to give you the money. They are not going to give you any of the retained earnings because you are buying the company, fine, but they are not going to give you the other contributor capital. We are going to eliminate it. So we don't need it now. Other retained earnings will be eliminated and the common stock will be eliminated because we are buying the equity of the company. So our investment is going to cover their equity that we are buying.
So why we are adding the stuff like we are paying the company, like goodwill, we are paying them. Why we are adding in our balance sheets and
Good.
the common stock
Because
too.
very good. Remember what we talked about the new rule of the new rule regarding the goodwill. Before the goodwill should be write off as an expenses. Once you pay the goodwill, excess money you are paying is a goodwill. Write it off as an expenses. Now they said no, you cannot write it as an expensive. On chapter 3, we are going to test. I think this chapter 2, we are going to test the goodwill. Then we are going to write off the loss of the goodwill every year until the goodwill becomes zero. You cannot write it off as an expense. Before the new change, you can write the goodwill as an expense. Now you have to capitalize, not to capitalize it. You have to do something called a goodwill impairment. Every year, you have to see if the goodwill is impaired. Impaired means that as goodwill lose its value, we are going to do a test to see if you have lost some value of the goodwill every single year.
And let's suppose we just pay them a common stock. It's like a common sense, like they are coming in our company. Let's suppose if we pay the cash, how we gonna put in our balance sheets?
Yeah, if you pay the cash, we are going to subtract it from our cash. So that's a good question. Let's assume that we didn't give them the common stock, but rather we give them the cash of $100. I'm just making an assumption. Then we are going to see this one. We are going to take our 240 plus the 10,000 minus the cash that you paid, minus the cash that you paid to get a company. If you pay 160 minus 160,000 that you pay to get a company. Does that make sense?
Yes. And how about the
Yeah.
equity?
The equity, very good. That's why we said the equity, we are giving them the equities. Therefore, their equity here, we don't need it. It's not coming at all because we are acquiring the equity of the company. And that, remember the consideration chapter 1 we talk about. You can give them a cash, you can give them the stocks. In this case, you are giving them the stock, or you can give them the debt security. So it depends on what you are giving. Here, because we are giving them the equity, we don't need to subtract from the cash because we are not giving them the cash. We are exchanging our stock for their equity. That's why we didn't subtract any equity from the cash because we are not paying them cash.
Okay, so it's like we are paying them, but we are making them a partners, kind of.
Very good. Any other questions, please? Any other questions? Okay, so we have, I know we have we are going to do this one, and we have more here too. We are going to see, because this also, they are giving them the stocks. They are giving them the stocks as well as the cash as well. So we are going to do this one on Wednesday. So attendance, as we always be taking, I told you guys, attendance is taken automatically. Oh, let me show you guys the attendance and see if anyone here that he was in the class last time, but give me 1 second. We didn't I missed the person. Give me 1 second here. And let me attach the attendance sheet. I have to submit the VOE by the 15th. So this person, I have to remove this person from class. I have to remove this person from class. So look at attendance, please. Check the attendance and make sure that I make you present here. Please, our last class was last week on the 4th. We were missing only Andrew was not in the class. Lopez was not in the class. Stephen was absent. Elizabeth was absent. Fazana Nala was absent. Is he here today? I don't know. Was absent. Kathleen, you were absent, right? Or were you in the class? It shows that you were absent on the last week, Wednesday. Were you in the class?
I was absent.
Okay, good. We have Govia was also absent. Gabriela was absent. Kellan was also absent. We also have Carlos. Carlos was absent. I don't know if he's here today. Richard was also absent. That's it. Those are the only absences we have in the class in our last class year. Okay, so guys, thank you so much. I will see you guys. Yes.